Good evening, everyone. Welcome to today's webinar on the new income tax framework. Thank you for taking time to join us. I'm Riaz Thingna, partner at Thornton Bharat, specializing in tax advisory and regulatory services across both domestic and international tax matters. The new Income Tax Act represents a significant attempt on the part of the government to simplify and rationalize the direct tax system. The emphasis has been on simple language and introduction of tables and charts to make it easy to understand. This is not a new law. Hence, there are no significant changes in the legal provisions. The principal aim has been to increase transparency, streamline compliances, and foster a more equitable tax environment, which in turn will result in reducing interpretational disputes by minimizing ambiguity. Finance professionals will appreciate the Act's commitment to transparency and regulatory certainty, hallmarks of a progressive tax regime. To discuss the changes and their impact on the businessman, we have an extremely august panel. Let me introduce you to the exceptional panel of experts. First, we have Richa Soni, a seasoned tax and regulatory expert with over 30 years of deep experience. She has been actively involved in monitoring and analyzing key tax policy developments and actively makes representations before the government authorities. She has also been part of several thought leadership publications on policy developments. She leads the technical tax team at GT Bharat. Welcome, Richa.
Thanks, Riaz.
Our next panel leader is Fatima Hunaid. She has over 27 years experience in transfer pricing and international tax. She advises multinational enterprises across transfer pricing lifecycle, from operating model design and implementation to price setting, documentation, and dispute management. A strong advocate of dispute avoidance, Fatima has led numerous advanced pricing agreements and safe harbor engagements, and is widely recognized for a contribution to strengthening governance in related party transactions. She has also been consistently featured in the International Tax Review Women Tax Leaders edition for several years. Hello, Fatima.
Thank you, Riaz. Happy to be here.
Thanks. Then we have Akhil Channa, who's a chartered accountant with significant experience in advising clients on tax, social security, labor laws, and other regulatory matters across diverse industries and geographies. He brings deep expertise in expatriate taxation and cross-border planning. His experience spans international secondments, tax equalization, and hypothetical tax policies, and addressing complex cross-border tax issues, including double taxation and treaty benefits. Welcome to Akhil. Our final panelist is Amit Kedia. He comes with more than 25 years of experience in inbound structuring, regulatory and tax compliance services for banks, AIFs, insurance companies, FPIs, NBFCs, and other financial services companies. His areas of expertise also includes providing advice on cross-border transactions, IFSC, GIFT City related advisory, assistance in obtaining regulatory approvals and in India and GIFT City, and managing tax and regulatory compliances. So welcome to all the panelists again.
Thank you.
We aim to make today's discussion engaging, insightful, and thought-provoking. Please do share your questions via the Q&A box. We'll try to take up as many as time permits. If we can't get to your question during the session, rest assured we'll respond to you over email later. Now, without taking any more time, Richa, let me start with you with a very basic question. What is the primary objective of replacing the Income Tax Act 1961 with the Income Tax Act 2025?
So, Riaz, as you mentioned in your opening remarks, the idea when this act was brought into place or formulated was not to make any significant policy changes, but to simplify the language. The challenge that was there with the earlier act, the 1961 act, was that it had undergone a series of changes every year in every whenever there's a budget exercise that happens, and there was a lot of patchwork changes that had happened in the act, which had made it a bit of a complicated piece of legislation. So what was felt was that we need to now create or draft an act which is more in tune with times, which is a modern, a more futuristic looking tax piece of legislation. And obviously, when the tax has to undergo a change, the entire framework needs to change. The related rules and the forms which implement the act also have to undergo the change. So this ethos of simplicity, ease of compliance, and so that it becomes a reader friendly law, that thing you will find in the this entire framework, be it the act, the rules, or the forms. As you mentioned, there is simple language which has now been used, the technical jargon which confused people, things like notwithstanding, use of provisos and explanations, all that has gone. The obsolete provisions have been reduced, which makes it a sizably smaller piece of legislation if we compare to the earlier one. There are tables. The similar provisions have been grouped together, which cause there's ease of reference that way. Many thresholds have been increased, which is the idea is to bring them, make them current in accordance with the current economic realities. The forms that we see here, they have been completely redesigned. They have a consistent look and feel. They are pre-populated to the extent possible. There are automated reconciliations, which implies that there are lesser chances of errors being made and therefore lesser issues on penalties and defaults. So overall, if we see around 35% reduction in the sections and the rules, and around 50% reduction in forms. So that's a big overhaul to say. One critical thing that we were all very used to, the concept of previous year and assessment year, which again the government felt was confusing taxpayer, has been done away with. So now we have a concept called the tax year, which is akin to a previous year in the earlier act. So that is how the taxation framework would work going forward. Again, the theme is simplification. Now, as we said, there were no major substantive or policy changes that happened at the time when the initial draft came into being or when the act was first codified. But what comes into play right now from 1st April 2026 is this act which has been modified or where some changes have been done by Finance Act 2026. So, the simplification plus certain policy and the substantive changes which were brought through the budget, they all get operationalized right now. So, apart from all the streamlining of the act, we have things such as decriminalization of the penalty or the prosecution provisions, as we say, the early dispute closure for misreporting cases, the rationalization of MAT provisions, so as to give a nudge to companies to move towards the new tax regime, and several other changes which came in through budget 2026 will also be implemented alongside this. So yes, it is indeed a major change for which the taxpayers now have to get prepared and implement this in a nice manner.
Great. So basically, simplification and a user-friendly approach, that is the mantra behind this. But then why was there a need for a master circular along with this?
So yes, this need has been felt because over the last 6 decades, a lot of circulars, clarifications have been issued under the 1961 Act. Now, these circulars, they served various purposes. One could be, they clarified the provisions. There were interpretational challenges which taxpayers were facing. They dealt with that, and also they provided relief in several cases. Now, the challenge is that many of these sections, as we mentioned, they are regrouped, they are renumbered, certain sections have been removed, so that one-to-one correlation with the existing circulars is creating a challenge. Then many of these old legacy circulars, they have been kind of overruled by courts. They have been withdrawn, sometimes partially, sometimes fully. All the sections which they relate to under the 1961 Act also have been removed. So there is a need that a compilation of all the circulars which are applicable as on 1st April 2026 is released. That will ensure that there is clarity both to the taxpayers as well as the tax advisors and the policy makers, the people who will be implementing on the ground, the tax officers, of what circulars are actually relevant. Uh, the requirement of this also comes from the repeals and saving provision, which says that all the old circulars, to the extent they are not inconsistent, will continue to be applicable. So, therefore, in order to ensure that there is ease of compliance, there is no interpretational challenges, we are all on the same page, both the regulator as well as the assessees, there is a need of a master circular. And also, this will be in sync with what all changes have we seen on the rules and the act and the forms front, where the extra stuff, the cleanup has happened. So I suppose a similar cleanup is required on the circular front as well.
Great. Thank you. Thank you for setting the context of this whole change. Let me move to you, Akhil. Now, the perquisite valuation rules have changed, especially for company provided cars, meal coupons, gifts, etc. Could you guide us through some of the significant changes and also the impact on taxpayers if they're under the old regime or under the new regime?
Thanks, Yas, for asking such a topical question. That too, at the time when most of the people are in the process of selecting their tax regimes, flexi components while structuring their salary in the companies. As you know, in the month of April, the people, open up the windows, employer open up the windows for the employees to choose which regime they should follow, what all flexible components and all. And that's why it's very relevant question, and it's very important for people to understand because the changes are quite some. There are a lot of changes which have happened. And let me walk through some important employee-friendly changes. As I said, in the new income tax rules, especially around employee perquisites, and to be for the people to relate. I think we have a PPT also on the screen showing the kind of changes. We'll come to that, but it's important to understand the rationale behind it and the objective why these changes have been brought in. As you know, in the earlier valuation of employee benefit, what we call perquisites, in Income Tax Act 1961, the perquisites are spread across many different rules. It was detailed and a bit complicated for a person to understand. However, as Rich also mentioned, under the new new Income Tax Act, the rules are brought together into one clear rule, which has a standard tables, clearly laid down the monetary limits, and are less ambiguous. This should make life easier for HR, payroll, and employees at large. Now, let me take you through, some of the benefits. To start with, value of free food voucher. As you know, there's a concept of free meal, which is provided to the employees in the old act. The exemption was only 50 rupees per meal, and that too up to 2 meals in a day was allowed. However, if as you know today, you don't get anything in 50 rupees, so it's a need of an hour. And now this is changed to 200 rupees per meal up to 2 meals, which is again a very welcome. But the important point to note is it's allowed only under old regime earlier. However, now under the new income tax rule, it's allowed under both old and new regime, which is a big relief for the people at large. HRA benefit, the 50% exemption rule was allowed only for the 4 metro cities. However, now they've understood that obviously they've not increased the limit, but they've added that additional cities under that 50% limit, which is Hyderabad, Pune, Ahmedabad, and Bangalore, which is again a big move, but it's only allowed under the old regime. Children education allowance. As you know, from last, I think since 1961, it's 100 rupees per child, and maximum it's allowed for 2 children. But the cost of education has gone up, and it was a demand we have been making. Even under the old act during the time of budget, that then limits for children education allowance and children hostel allowance should be increased. So that both limits have been increased exponentially. For in spite of 100, it's 3,000 rupees per month per child. And for hostel, it's from 300 per month to 9,000 rupees per month per child, and maximum for 2 children is allowed. And the interesting part is, it's if it's in the children is in the play school, main school, institute, in the college, it's allowed, but only for the people who did for old regime. Again, a significant change in the value of any gift or voucher given to the employee. As you know, in the organizations, there's a concept of giving gifts on anniversaries, birthdays, and festivals. The limit was very minuscule. It was 4,999. Though it was allowed both under old and new regime in the previous act as well. But now the limits have increased 3 times. It's 14,999 and allowed under both the regimes. So it's a very, very welcome step. Even for the car, employer-owned car or provided car, as you know, there's a concept of car lease scheme, which is very prevalent in many MNCs and organizations at large. The limit was very, very less, 1,800 rupees per month for small cars, which means that cubic capacity up to 1.6 liter, plus 900 added if the shopper is there, and 2,400 per month for bigger cars above cubic capacity of 1.6 liter. So that was very highly an amount. I think they've understood the requirement of today. The cost has gone up, the vehicles and everything. So that's why they've increased that limit from 1,800 to 5,000 rupees. And 2,400 to 7,000 rupees for that matter. Even for the shopper, the benefit was the 900 to 3,000 and 900 to 3,000. So which is obviously the government also wants to understand the EMIs have gone up and everything. So the taxable perquisite has increased there, which obviously hit the people. But when the government is giving benefits in other whether it's children education or not, so they have to increase that accordingly. Interestingly, in the old act, the electric vehicle was not clearly included, but now they've included electric vehicle. If the people have to avail that benefit, they can do that. For employee-owned car, I think the exemption is restricted to above mentioned thresholds, and similarly, the benefit is also increased if the car is owned by the employee, where the benefit from 1,800 to 5,000 will be given. I think existing threshold in interest-free or concession loan amount is 20,000, and it's increased to 2 lakh rupees in the new act. So these are the changes I just want to highlight for the audience at large. If you ask me to sum up, the rules are simpler and more consolidated. It's the requirement of the time that government understood. The perquisite values are more realistic, as you know. Employee benefit from higher exemptions and limits. Overall, there's more clarity, less ambiguity, and tax savings for the employees.
Great. Thanks a lot, Akhil. In fact, in keeping with the spirit of the new Income Tax Act, your table has also provided a lot of clarity on the real changes and the impact on the taxpayer. Let me move to Fatima now. Fatima, Form 48 replaces the traditional Form 3CB with significantly enhanced and more granular disclosures. From a government and controversy management perspective, Do you see this evolution primarily enabling sharper risk-based assessments by tax authorities? Does it also materially raise the bar for internal disclosures, documentation consistency, potentially leading to heightened scrutiny in transfer pricing audits? Padma, your views. Yeah.
So, Riaz, let me paint a picture of the old form visually. Akhil showed a table. I'm going to help people visualize the old form, which was called Form 3CB. So, think about a table, different sections of a form that require the company that's engaging in international transactions to disclose the categories of transactions, the value of transaction, the method chosen, the book value, and the arm's length value. In a nutshell, there were various categories for which these three types of information was being disclosed. Now that was being triangulated with by the department along with the P&L information, whether the company is loss making or not, and the tax information that they had, the amount of tax paid, etc. And this information to identify whether they would audit the company or not. Now, traditionally, if we go by our experience, way many more MNC companies were being audited and picked for audit, and the chances of adjustment were almost 50%. So, even if it was a carpet selection, I would say there was some intelligence built in, but essentially, if they were picked up, the rate of adjustment is also very high, irrespective of the fact that the values may not be that high, relatively speaking. Now, let's come to the new form. It's integrated and it's a single form, but what's of interest here is that it contains a blueprint of the economic analysis of the transactions, which was never there in the form. So now what you get to see is how each category of transaction is actually benchmarked. What are the comparables and what is the interquartile range? I mean, depending on which method is being applied, So that entire information will be in the form, and the department can actually dissect the data, profile the data, triage the data. In addition to the previously available information that was coming through the old form, the new form will now enable all the benchmarking data, the economic analysis, including how the company transactions are showing up in the context of the benchmarking. So they will know which ones to kind of select and which ones to, where they can get maximum value or where there's maximum misalignment, so to speak. So when I use the words maximum, we really don't know what thresholds they may place to the risk parameters for selection. But definitely responding to the other part of your question, now that we know that this information is going to be required to be submitted, companies also need to make sure that the transfer pricing documentation is contemporaneously prepared ahead of the finalization of Form 3CB, because all of that information needs to go into the form. The other thing which is super important is that the tax positions, the narrative of the documentation, and the economic analysis, they all speak the same story, so to speak. Right. So that will be very important for the tax positions to be consistent across. For that, the documentation needs to be ready beforehand. And all of us practicing professionals know how the due dates stack up one after the other after statutory audit. So there's not a whole lot of time after the tax year ends. So all of these changes indicate that one needs to be even more proactive in assessing, diagnosing what the tax positions are, how their benchmarking is being done, so that they can be prepared beforehand to identify and address risk areas. And I think lastly, it's not just, I won't say it's just a compliance overload on MNCs. It gives them an opportunity to proactively identify risk areas and address them. So overall, a pivotal change in, signaling a lot of data collection, blueprint of economic analysis, and proactiveness in addressing what will go into the form. Back to you,
Great.
Riaz.
Great, Fatima. That was extremely clear. So basically, while one will need to be more proactive, one can expect maybe less adjustments if at least one can be hopeful of that. Yeah.
One can with the right support and
Yeah,
proactiveness.
surely. So now I'll come to you, Amit. Now, Amit, what is the key impact of the transition of the Income Tax Act to the new Income Tax Act, read with the rules on the financial services entities, particularly banks and NBFCs? Do you see any significant impact there?
Right. Yeah. So thanks for that, Riaz. So as you and Richa mentioned earlier, that the Income Tax Act has been introduced by the government to make the income tax system little more, user friendly. This includes reorganizing sections, rules, and now they have put, schedules and tables well structured in the new tax law. Just taking an example of TDS provisions, earlier they used to be several sections through which the TDS provisions were mentioned. Now, what they've done is they have consolidated everything under one particular section, which is Section 393 of the Income Tax Act, new Act. Again, in terms of implementation of the Act's provision, the new rules were notified a few weeks back, and which again aligns with the whole thought process of the government of India, wherein some of the key changes which relevant for the banking and NBFC sector would be changes of the tax deduction limits, revise PAN requirements, for example, and or new formats in which certain forms have to be provided by the customers or by the banks to the tax authorities. While there are no substantive changes in the tax law, but equally with the changes, as I mentioned about in the rules and forms, etc., where banks and NBFC in particular, they do a lot of bulk of the compliance reporting with the tax authorities, and hence there is a considerable amount of effort impact on their day-to-day operations, which includes alignment of the system, processes, etc. Just maybe if I can dwell a little bit more on that, basically, in case of banks and NBFC, changes in rules and form you require, for example, their KYC documentation needs to be updated for obtaining PAN. Their agreements, existing agreements or new agreements, there would be mention of section, rules, forms, PAN requirement. Vendor onboarding again would be something where a lot of those documentation needs to be updated by them. Employee related, payroll structuring, which Akhil spoke about, and equally also with the filings which the banks and NBFC typically do in bulk with the tax authorities on a regular basis. I think a lot of those things needs to be updated and changed. As a result, there are possibly in banks there would be more than 100 SOPs, internal SOPs, which are there. There are n number of agreements which they would have on an ongoing basis for their customers, vendors. A lot of declaration which they take, all the branches take on a regular basis from the customers, vendors, marketing material, website links, and content which are there, and most important, the internal IT system which needs to be geared up to these requirements. In fact, taking up very quick example of a recent assignment or a couple of assignments which we've done recently for banks and BFC, where we've done a similar processes of hand-holding clients end-to-end purposes, which included tax advisory, reviewing their documents, suggesting changes, and then finally reviewing the changes made and providing sign off from our side. So all in all, I think this transition to the new act and rule has been an important element, a project, I would say, for a lot of these banks and NBFC over last few weeks. And I'm sure a lot of banks have done the needful, but equally there is still it's work in progress for a few of them. So it's an important change which has happened, transition change once in a while, once in last many decades, and it's been I think a journey which most of the banks have navigated very well.
Great. Thanks, Amit. So you can expect a lot of adaptation that the financial services industry needs to go through. And but I guess it is in the interest of long-term benefits. So let me come back to you, Richa. Now, buyback tax that has seen a lot of seesawing over the years. Now, how has the tax treatment changed for buyback proceeds in the new Income Tax Act?
So yes, this is again something where the change has come through Finance Act 2026, so Budget 2026. Now, we have again moved back from the dividend style taxation and restoring the capital gain style taxation was there. The benefit to the investors is now that they can factor in the cost of acquisition and the net proceeds get taxed at the rates which are applicable for capital gains. Now, there was a challenge which the government felt that this could be used as a tool, as a tax arbitrage tool by promoters, where this could be used as a substitute for dividend. So for taking some proactive steps to deter this sort of a practice, what has been done is that a differentiated rate has been given for promoters. So promoter companies in this case of buyback, they get taxed at 22%, and the other promoters they get taxed at 30%. So this ensures that there is no misuse of this provision going forward. Also, what this change does is that from a non-resident taxpayer's perspective, the entire last year, we as advisors and the taxpayers, the non-resident taxpayers, were struggling on how to classify this stream of income under the tax treaties. So different tax treaties had a different terminology being used. So how that classification had to happen was becoming a challenge. With this change, this classification challenge goes away. So therefore, there is less possibility of dispute happening on the in the cases where the shareholders are taking treaty benefit, and therefore a classification under the tax treaties is required.
Great. Thank you, Richa, for that. Akhil, let me move to you. There's been a lot of interest, as usual, on the TCS rates on overseas remittances. Now, I understand that the new Income Tax Act now has reduced TCS rates. So, how does it impact individuals remitting money outside India?
Yes, Riaz, again, very important question, especially for the individuals who are remitting money outside India for their children education, medical treatment, or tourism purpose for that matter. So it's very important to understand what was the rate earlier and how this will change. So earlier, TCS rates on foreign remittance were quite high, as everyone knows. In many cases, individual had to pay 5%, 10%, or even 20%, which means a large amount of money gets blocked upfront. Obviously, TCS is not a final tax and could be claimed back later, as you know. It still causes liquidity stress, especially for education, medical, and travel expenses. So what has changed now? Under the new law, in fact in effect from April 2026, TCS rate has been rationalized, with time, especially for the category of on foreign education and medical treatment. It's a big relief. Let me talk about the people who are sending their children or themselves, going out for a foreign education, and even for medical treatment. The TCS is now only 2%, which is again a very big relief, and it applies only if the total remittance exceeds 10 lakhs in a financial year. And even better news for the people who are going for an education. If overseas education is funded through a loan from our recognized financial institutions, which are provided there, no TCS applies at all. So irrespective of the amount, irrespective of the limit, no TCS is applied, which is a big relief, especially for the students and parents, and improves cash flow significantly without any liquidity stress. So that's the first category. The second category is overseas tour packages. As you know, there are a lot of aspiring, travelers, and then there are people who've been traveling abroad, both for personal and official purpose. The TCS is going up to 20%, which is very troublesome for genuine travelers and people who are aspiring to travel abroad. Now, a flat 2% TCS applies, and it applies from the very first rupee, no limit. And old slab base and high rates are removed. So that's a big relief again for them. So this makes the system much simpler, more predictable, and for easier for people planning overseas vacation. So that's there. However, for other kind of remittance, whether it's a foreign investment or you want to buy property, sending gifts to relative overseas, the TCS rate of 20% continues to apply once the total remittance exceeds 10 lakhs in a financial year. So the government continues to keep close monitoring while still allowing credit or refund later, as you know. But this is the big change. And if you ask me to sum up whether it's positive or not, yes, it's very positive. Especially the people who are traveling outside for education, medical treatment, or tourism. Genuine taxpayers face less liquidity pressure, and overall the changes creates better balance between compliance and convenience.
Thanks, Akhil. This is really welcome news. It has been a long-standing demand, and it really provides a much-needed relief to the common man. Fatima, now coming to you again, the new act seems to clearly pivot towards dispute avoidance and create a lot of certainty in transfer pricing. Do you see this as a structural shift in how taxpayers will engage with the Indian tax authorities? But more importantly, does a framework truly deliver certainty? And now with these various options, how does a taxpayer select between APAs, safe harbor rules, and other options to manage their long-term controversy without giving up on their commercial flexibility?
Absolutely, Riaz. So, when we look at the options available in order to obtain tax certainty and dispute avoidance for transfer pricing specifically, we essentially have two schemes, which is the advance pricing agreement, safe harbor regime, and of course, the transfer pricing policy setting in itself can be in a way that doesn't kind of be at the edge of dispute, right? So either you're extremely safe and conservative in your transfer pricing policy setting itself, so that you don't get picked and have a high chance of adjustment, or then if most businesses would want to be prudent, they would want to be careful that they are not left with extra resources in any particular country, will want to have really tight transfer pricing policies, which means they need to balance the litigation risk in India. And Riaz, like I mentioned earlier, the risk of adjustment is pretty high if the company is selected for audit. And therefore, yes, advanced pricing agreement scheme introduced in 2012 has been really running a juggernaut, I must say. And if the announcement by the CBDT, in terms of numbers this year are extremely encouraging. So 219 advanced pricing agreements were signed, out of which a staggering number of 84 were bilateral APAs across 13 treaty partner countries. So it's not just limited to UK, US. We have several first-timer countries like France, etc., that have now also joined the bilateral agreement bandwagon. What I truly feel like a professional, something I have been waiting for over the years, is the rationalized safe harbor scheme. So essentially, I always wondered, with all of the experience the department has gathered auditing companies since 2020, 2001 financial year when the transfer pricing regime was introduced in India, they have significant experience. They pretty much know how businesses work, what are the supply chains, value chains, and what they have been consistently assessing in terms of what would they like to see offered in India, right? So all of that knowledge, whether it's through regular audits or through advanced pricing agreement, they have assimilated all that and brought it into the safe harbors regime. So now the safe harbor regime is available for a block of 5 years. Earlier it was annually being notified. So that's the one big change. And all of this again is available from tax year 2026-27 onwards. So one is it's available for 5 years. And if I take IT services, the services that are provided by Global Capability Center is how their companies are now being referred to as, providing a variety of different IT services, software development, IT-enabled services, knowledge process outsourcing services. All of these different categories of services, now the government has unified into a single IT services category. And for that unified category, they have announced a profit safe harbor threshold of 15.5%. Now, which was great news because you could never hope to get that percentage without litigating or negotiating over several years. And the safe harbor, this is the best part. There is no government filing fee. But yes, you need to do the due diligence. You need to see that you meet the various conditions and then make an application available for 5 years at 15.5%. This is the one thing that several large or small MNCs would ask me, Riaz, as a professional. Tell us one percentage with which we know we can then operate and focus on business. And none of us ever had a percentage where we could tell them, yes, certainty is guaranteed. But now we can say that. So now it's up to the businesses to choose. They have a complementary system of tax certainty mechanisms available for low risk IT services operating at scale or not. Safe harbor is a way to go. And once they breach the 2,000 crore annual value threshold, or their complex transactions, non-IT services transactions, they can go for APA. And on the APA front also, there's great news because earlier there was no due date to complete the APA negotiation process. But now a 2-year time frame has been introduced. Unless the taxpayer wants to extend it. So that is the good news on the APA side, the safe harbor side, and together they offer a very robust system of tax certainty. There will always be companies, Riaz, whose supply chains, value chains mandate them. They're not able to go into the safe harbor threshold. So then they may consider APA or at least consult with consultants and see what best they can do in order to have a robust documentation. And I would come back to reference the form, right? So have your benchmarking in place. And I want to quickly address 2 points which came up in the questions as you were engaging with the other panelists. Is that one clarification? The new form is applicable from tax year 2020, 26, 27 onwards. 26, 27 onwards. And the benchmarking, several have expressed concerns that financials will not be available of comparables because they get published later, but you have to file your return and your Form 3CB 48 beforehand. So the only way of addressing it is use multiple year data, make your documentation, because with multiple year data, the interquartile change may not change materially, may not. But then also it's about which point are you at. If you're on the lower side, the potential of going outside the range is also there. So I think I'll stop at that and say that yes, the government is moving towards more and more certainty. I have one interesting point. I'm sure Riaz, you'll ask me later as we go along, which might be a little counter to what I'm saying now. But yes, that's how tax law is. So over to you.
I think great. So there's a lot of positive news on the transfer pricing side, and thank you for really succinctly putting it down for us, Fatima. Amit, moving to you, what changes in the reporting requirements have been introduced for cryptocurrency exchanges under the Income Tax Act? Could you just elaborate on that?
Sure. So basically, virtual digital assets (VDAs) in India have evolved significantly over the past few years, with increased participation from retail investors and growing regulatory oversight. Tax compliance and reporting has become very important element, today. The new Income Tax Act, along with the rules, has introduced significant changes in the way VDAs must be reported by crypto asset service providers, CASPS. The definition of VDAs under the Act has been broadened with effect from 1st April 2026, bringing a wider range of digital assets within its scope. Also under such comprehensive reporting, there has been a comprehensive reporting requirement now where CASPS, which is crypto asset service providers, are now required to file an annual statement in Form 167 by 31st May of every year, as per the rules. Where there are no reportable users identified by the service providers, still they will be required to file a return. So hence, compliance is no more optional, but it's mandatory. As a result of all these things, exchanges especially will face higher compliance burden and cost. For users, they will have to correctly report all their transaction in crypto assets, etc., in their tax return. Failure to do so may invite scrutiny and other implications. And for the tax authorities, these reportings will help them and acquire whatever data they were looking for relating to VDA ecosystem. So in short, compliances have increased to larger extent for the service providers under the new tax regime.
Great. Thanks for that clarification, Amit. Richa, I'll just turn to you. What proactive steps has the government taken to ensure the smooth transitioning to the new regime?
So, Riaz, it seems a lot of groundwork
Abhi,
has been done. A lot of work has been done by the government at the background, considering, and I'll take cue from for standing committee report which they submitted at the Lok Sabha in March. So it seems that, since there is going to be a parallel operation of both the 1961 Act and the 2025 Act for certain transactions and for certain years to come, the e-filing portal has been equipped in a manner that it can handle both the laws together. So there is multiple year access which is possible. The historical data continues to be available. That ensures that there is ease of navigation and you can continue your compliances as required under whichever regime your transaction falls into. That would be one. The second is that there are about 190 forms that are there. So, and to implement them all, utilities of all need to be created. So what they've decided is that the time sensitive one and the earmarked 54 such forms, which are more time sensitive, they'll be released first, and the other ones which can come later, so that there is no operational challenges which are faced by taxpayer. There are massive media campaigns which are being run to educate taxpayers. There are training exercises being done for the tax officers themselves. FAQs being released on various facets of the changes, so as to ensure that there is a smooth transition and people are aware of what actually changes at the ground level. So it's important actually for taxpayers to take stock of what the FAQs are saying, and also navigate through the portal, the realigned portal, to see if there are any challenges that are being faced, because there is a proactive redressal that's happening. So that's something that they should bring out currently before the government.
That's positive news, Richa. Akhil, I'll turn to you, and I'm aware that we are running a bit short of time because I've got many questions to go. But I'll try to just concentrate on focus on some important ones. So, in capital gains taxation, for individuals especially, what have been the major changes? And I'll club it up with another issue also, that there have been some changes in the foreign asset disclosure requirements. So could you, even refer to that and let us know what are the consequences if there are misses in reporting? So both these, if you could just guide, throw some light on.
Yeah. Quickly, I agree with you. We are short of time, and yeah, just to give you a perspective, I've answered a lot of questions while you were talking to other panelists. I've tried to answer, and people have a lot of questions on the foreign assets reporting and everything. So I'll break your two questions. One is the capital gain. If you ask me, no big change. It's just that better clarity. Um, and the way the law is written, as you know, in the past, the basic capital gain structure, how it was written, and now I think it's mostly the same. Tax rates are largely unchanged. There's no new tax on investment as such. The capital gain provisions have been cleaned up, restructured, better linked between charging, calculation, and reporting for that matter. So that clarity has come. So that's why I said no big change, but just better clarity. However, the people have some clarity which people are looking on ULIPs, which is unit linked insurance plans, and again there's no change. It's just a continuation. As you know that for ULIPs issued on or after 1st of February 2021, if the annual premium exceeds 2.5 lakhs, then the maturity receipts are taxable and they are taxed as a capital gain. So that continues as it is. Even for high premium non-ULIP insurance policy, there was a change which was brought in 2023 that after 1st of April, if the annual premium exceeds 5 lakh rupees, then the tax exemption of maturity proceeds is withdrawn and it's taxable. So I think the government has continued with that. The intent is very clear. They want to continue giving tax benefits for genuine insurance protection, uh, uh, tax high value investment oriented insurance products in line with other investment. The new income tax act does not introduce any new taxation here. It is simply continues and reinforces the framework that was already put in place over the last few years. Now coming to your next question, which is on the foreign asset reporting. I think I need to break this down quickly into different parts. First of all, who are required to do a foreign reporting? There are two schedules. One is a foreign assets, which we say Schedule FA. One is a foreign source income, which we say foreign Schedule FSI. So the reporting goes in both the schedule in the ITR, and the people who are resident and ordinary resident are required to disclose their foreign bank accounts, foreign shares, securities, ESOPs, immovable property, and financial interest in foreign entities under both the schedules. If they have only assets, they report into assets. If they have income, they have to report under the foreign source income as well. Um, what has changed? That's very important to understand. Right now, it's largely self-driven, self-declaration driven. The system largely depend upon whatever the taxpayer declared. And if there's misreporting or non-reporting, that detection of non-disclosure generally happens in today's scenario when the scrutiny comes in, or through specific information exchange between different countries, or where large income mismatches were visible. However, going forward, I think it's more on the common reporting standards, CSCR, CRC, as where the government is getting information and the factor related information exchange. So the authorities are getting the information and they will have more details, which obviously taxpayer has. But if taxpayer is not able to report, then it will automatically flagged, and the department will have that information available with them. So practically, if you ask me, from self-reported information to data match information is a big thing which undergoes change, and the consequences, the penalties are huge. So in a nutshell, disclosure of foreign itself is not new. What has changed is the environment in which disclosure happens. Earlier, it was largely based on what the taxpayer used to choose to report. Today, it is measured against information automatically received from overseas tax authorities, as we discussed. As a result, foreign asset declaration has shifted from a routine compliance item to a key risk management requirement. People have to manage that and ensure that otherwise, as you know, their penal, their interest, and even Black Money Act get applicable in case of serious cases. And accurate reporting today is less about form filling, more about matching global data.
Great, Akhil. I think that's very important because there's a significant change there in terms of consequences, and one has to be aware of it. Very, very rightly put. Fatima, I'll come to you now. The concept of associated enterprise. Now, with the change that has happened in the language, it appears that the concept of associated enterprise has been materially widened. So, do you see this shift as a deliberate move by the government to actually override some of the judicial precedents that we had? And what impact do you think how industry should rethink the associated enterprise identification and risk assessment for transfer pricing in this new environment?
Yes, I think we can take a best judgment guess over here in terms of whether it was fully intentional or it was done in order to cover a few specific cases that in the new age economy, in the integrated asset light supply chains, value chains, the current instances which are there in law are not getting covered. Perhaps that's the intention. But what has ended up happening is that earlier, again stepping back and going to the old, the definition, see, the associated enterprise definition really is the starting point for applicability of transfer pricing regulations. So it's extremely important and fundamental for the transfer pricing regulations. And earlier, it covered general, it had two limbs. The definition had two limbs. One was the general principle, which is participation in management, control, or capital, directly or indirectly. That was the first limb. The other limb had specific 13 instances. Like there was a threshold of 26% for shareholding. There was a 10% limit on guarantee of loans taken by the other enterprise. So similar examples of board positions, etc. 13 different situations were described. So that portrayed and brought out substantiveness in the context of general principles. But in the new law, the two limbs have essentially been merged into one continuous set of conditions. So they operate independently and also together. And which is where you're right that it has in effect widened the scope of associated enterprise definition, and several representations were made. So essentially, the hope is that in the next budget, which will come out within the current tax year, in which the new definition is applicable, there is a much needed change, which kind of limits the scope. Otherwise, even one share or 1% shareholding can constitute associate enterprise relationship. And you know how onerous the transfer pricing regulations are. It may end up being counter purposes and open a whole lot of litigation and compliances, which is not. I'm sure it's not the intent of the government. So this needs to, kind of ring fenced and amended. But in the meantime, one can't live in hope. So one very important thing which I would recommend be done by companies is that if there were borderline cases of associate enterprise relationships, or there were others which are there but were left out and not covered, then companies be extremely careful. And I'm not talking about 1% shareholding, but really borderline cases where one is sure that, and one is clear that there is participation in management, control, or capital, but just relying on the earlier wording of the law, they were not included. So those one needs to step back, review, and map them into the transfer pricing applicability.
Thank you. Thank you very much, Fatima, for the clarification. We are really short of time, but I'll ask one question to Akhil. Akhil, what do employees need to consider for compensation restructuring post these changes, as well as the labor law, labor code reforms that we had gone through earlier?
Thanks.
Very quickly.
Again, very topical question. As you know, the new labor code regimes are there, and it's a time for employees to choose their new structure. I think though the tax planning is always important, but it's more on the compensation designing now, which is more efficient for the employees, and employees need to understand where their investments are, their expenses are majorly centered, whether it's towards a mobile handset, buying a mobile handset in a year, or getting a mobile recharge. Whether I think someone asked in the questions as well, prepaid and postpaid both are allowed. Yes, both are allowed. And even books and periodicals, professional development allowances. If that's not a part of the structure, you will not be able to claim the benefit even in the tax return. That was a question someone also asked while I was reading the questions. So what you need to do, you need to understand your spending. You need to discuss with the employer. And as right now employees are undergoing a change because of new tax benefits which are there, we discuss as a first question the substantial benefits under the new tax rules. and new labor codes on the corner. The employers are doing the restructuring, so employees should discuss with their employers that these are the components which are both beneficial from a tax side of it and even from a social security side of it. Rationalizing the wages under which tariffs has to be provided for. So have that discussion, and whenever the window opens up for you, just go for that flexible components and ensure that appropriate receipts of your spending, whether it's for leave travel allowances or books and periodicals or professional development or mobile handsets, should be claimed appropriately during the financial year. So that with
Thank you.
this, I think we can close.
Thank you very much, Akhil. We are really run out of time now. There were many questions which I would have liked to ask. We've also received a lot of Q&As on the chat. We will respond to all of them post this session. Let me thank all the panelists today for providing a lot of clarity on very interesting changes which are coming in, which are impacting the day-to-day practice. Even though there might not have been a complete change in the law, there have been a lot of things which will impact the compliances. And of course, there are a lot of changes even in forms that we'll have to look at. Thank you very much, and thanks you to the participants for really participating wholeheartedly. Thank you.
Thank you very much for the hearts and the applause, and